Joining me right now is independent advisor, Alliance Chief Investment Officer, Chris Zaccarelli. Chris, great to see you. What did you take away from Powell's comments yesterday?
I think Powell's comments were really interesting. You know, we've had some higher than expected inflation data so far this year, and that could call into question whether or not we'd really get those 3 rate cuts. But really, Powell doubled down. He really said, we're not going to change our rate cut forecast. We believe that inflation is coming down, although maybe we've seen some bumps along the way. We're not so sure. We think the 3 rate cuts could potentially be in jeopardy, but only really at the margin. So maybe they cut 2 times starting in July as opposed to 3 times in June. But ultimately, the Federal Reserve has raised rates to this high level, 5.5%, and they're planning on just keeping them for a longer period of time. And that's really just kind of punting on what they've seen so far in the data and just hoping that the data over the next few months come back down and are in their favor. So that's really where we stand right now.
Mark.
Chris, you know, I agree wholeheartely with you, and I've been having talks internally with my team about what could potentially cause a pullback in the stock market, because as you know, in election years, that drawdown is typically somewhere in like the 15–16% range, and we've seen nothing even close to that so far. And the one thing that we continue to harp on is the notion that if there is one more month-over-month CPI print up around 0.4%, because we've watched that number accelerate. It's gone from 0.2 to 0.3 to 0.4 the last 3 consecutive months. I think if there's another 0.4%, the Fed's going to come out. They're going to change their tone. They're going to come across as a little more hawkish. The 3 rate cuts you're talking about may be fully taken off the table, and that could spook the market. What do you say about that?
But I think that's a really great point as far as inflation starting to go higher, and that's something that they've been worried about all along. We share your concerns that the market could pull back. We don't know if it would be as much of that magnitude. That'd really put a scare into some people if it went down 15–16%. But absolutely, you know, maybe a 5% pullback on initial data, and then something else could trigger a deeper pullback. We've also been counseling our clients, listen, last year the market went up in a straight line. It typically doesn't do that. We do expect the market to be higher than we are from here. As we speak, maybe the S&P's up around 9.3%. We expect it'll be higher at the end of the year, but we do expect it to be a little bit more volatile, some bumps along the way. And you're absolutely right. One of the main things that could spook the market is continued higher than expected inflation prints, and that's why we think the risk is to the downside on the number of cuts and not to the upside. We expect, you know, 2 or 1 cuts if they deviate from their path, not 3 or 4.
So the next big catalyst is this upcoming Wednesday when we get the next reading on the Consumer Price Index. That's really going to be the big story for markets. But I want to look at some of the underlying components because commodities are on the rise. Gold, for example, at another new record. It's pulling back this morning, but look where we are, 2,313 following Powell's remarks. Oil prices, another issue here. Oil prices have been rising steadily, and now we're talking about crude at $85.40 a barrel. The Biden administration is now canceling its plans to refill the depleted Strategic Petroleum Reserve because it's too expensive. Prices are up 59% on Joe Biden's watch. Over the last year, they're up 5%, Chris. Do you expect oil to keep going up?
Yeah, I mean, that's been the big story for last year. It really wasn't talked about, but oil prices went down for most of last year. That really helped the economy not only continue to move higher, the stock market move higher while inflation was coming back down. We could be seeing a little reversal of those dynamics. We're not necessarily expecting an oil spike, but clearly oil's been moving higher. Now, whether that's because we've got increased demand and consumers have been more resilient than we expected, or maybe it has to do a little bit more with the geopolitical uncertainty, whether that's in Russia, whether that's in the Middle East. And clearly we've been talking about China, which has been on the back burner. But the world is heating up. We're seeing a lot more conflicts. We're seeing a lot more risks. And ultimately, we do think oil could move higher. Again, we're not predicting a big spike higher. But the big story, the big difference between this year and last year oil came down for most of the year, and that provided a lot of good tailwinds for both the economy and the stock market. That could be potentially a headwind this year, and that's something to watch, absolutely.
Chris, how much of this selling in the beginning of April do you think has to do with tax-related selling? Because there could be some artificial tax-related selling going up to April 15th, right? This week and even into next week. I'm wondering if people need to sell stocks to pay capital gains. They had good performance last year. Does any of that, do you think, do you attribute any of it to tax-related selling? And will we see sort of a reverse after April 15th?
I think that's possible, and at the margins, when you're looking at, individual investors in taxable accounts, that's definitely a possibility. And I'm sure you'll see that every year seasonally, that could be a factor. Okay. But in general, I would say, most of the money in the stock market is either going to be long-term money or money in endowments or pension plans where it's tax deferred, if not, tax-free. And so it could just be the rebalancing effect as well. At the end of every quarter, a lot of these large institutions, sovereign wealth funds, pension plans, endowments, as I mentioned, they like to rebalance. They try to get their equities and their fixed income back into whatever target range they're looking for. So it could be a factor of both some individuals for tax selling, as well as just your rebalancing effect at the end of the quarter. Both of those effects could be transitory. So we do think, that initial selling that we saw at the beginning of the quarter, that doesn't necessarily need to persist. And to your point, within a week or two, we'll be past the tax deadline here in the United States. So, what we'd be looking for, again, as far as pullbacks would be other catalysts, whether that's oil price spikes, whether that's inflation readings coming in too high. That's really what we're watching right now, and we think would be a bigger risk to the market.
All right, Chris, good to see you. Thanks so much. Chris Zaccarelli joining us this morning on Markets. We'll take a break when we come